Welcome, everyone. Good evening. Thank you very much for joining us, and super excited for our webinar today. Maybe, Faisal, whilst we wait for everybody to join, I can do a brief introduction to myself. So,
Go
everyone,
for it.
my name is Akshay. I am one of the wealth advisors on the team here at Sarwa. My background is in banking as well as private wealth management. Started my career at the Canadian Imperial Bank of Commerce in Canada, and following that, worked for a British private wealth management firm. So licensed and qualified as an advisor with the Canadian Securities Institute and also the Chartered Institute of Securities and Investments, and been with Sarwa now for just about 3.5 years. And look, very passionate about what we're doing here. I think Faisal and I have both been here for around the same amount of time, but really, really passionate about the financial education and wellness that we've been doing. But yeah, Faisal, maybe I'll hand it over to you to just introduce yourself while people join.
Cool. Thank you, Akshay. Hello, everyone. Welcome. Excited to be here with you today as well. My name is Faisal, advisor here at Sarwa. Same as Akshay, I've been here for over 3 years. My experience spans fintechs across the US, Saudi, and the UAE. I'm certified in wealth and investment management by the Chartered Institute for Securities and Investments as well. And yes, we're really excited for today's topic. It's a good one.
Awesome. Yes. So today we are diving into, I think it's an old debate, a classic debate. Are stocks or ETFs the better way to invest? So I think for a lot of people in the audience, whether you're new to investing or a seasoned pro, the discussion we're going to look at will hopefully help you weigh out some of those options. We're going to break down some of the pros, some of the cons of each of these, look at performance data, and explore which of these options might be the best for you. But we're going to change it up a little bit today, keep it a little bit more brief on the slides and the presentation part, and focus a lot more on the discussion. So please ask your questions in the comments. We're going to spend a lot of time answering those questions and have a bit of discussion about that. And look, we're hoping by the end of the session, you'll have a clear idea of, how to align your investment strategy with your financial goals. And I don't know, I'm not the best at Zoom, but maybe at some point in the webinar also, Faisal, we can figure out how to do a poll to see where the audience is leaning towards, whether it's ETFs or stocks. But
Definitely, definitely.
I'll pass it over to you now to get started.
Thank you, Akshay. Again, welcome everyone. So let's start it off. So today's topic, as Akshay mentioned, is stocks versus ETFs, the ultimate face-off. But before we begin, we just need to clear some formalities out of the way. Neither Akshay, myself, nor anyone else, for that matter, can predict the future. So whatever's going to happen in the next few months or years is unknown to us. And the views shared today should not be interpreted as one-on-one financial advice. Please do your due diligence before making any investment decision. And remember, all investments carry risk. So now that's out of the way, let's set the stage. And let's start with a simple question. Do you want maximum control or maximum convenience? If you like being in the driver's seat, picking stocks might be for you. But if you prefer a more hands-off approach with solid, steady returns, then ETFs might be a better fit. Think of it this way. Choosing stocks is like cooking a gourmet meal from scratch. You can pick the ingredients, you control the flavors, and if you do it right, the results can be phenomenal. ETFs, on the other hand, are like ordering a pre-made balanced meal. It might not be the most delicious, but it's convenient, nutritious, and it gets the job done. Understanding where you fall on this spectrum will help you shape your investment decisions. So let's break it down. When it comes to stocks, stocks will give you full control. Right? You decide exactly where your money goes. And if you have strong conviction, deep research skills, or industry knowledge, you might pick stocks that outperform the market. Think about Apple, Tesla, or Amazon. Early investors in these stocks saw life-changing returns. But here's the catch. Are you really good enough to pick the next Amazon? Because for every success story, there are countless stocks that crash and burn. So stock picking requires skill, patience, and a solid understanding of market trends. Otherwise, you might end up chasing hype and losing money. And another key factor when it comes to stocks is cost. So stocks don't have expense ratio. So when you buy a stock, you only pay trading fees and stock price itself. ETFs, on the other hand, come with small management fees known as expense ratio. While most ETFs have very low fees, over time they can start to slightly eat into your returns. The reality is that most retail investors struggle to consistently beat the market. It takes time and experience to develop a winning strategy, and even then, there are really no guarantees. So while stocks offer the highest potential for rewards, they also come with the highest risk. Now, let's talk about ETFs. ETFs offer instant diversification. Instead of buying one or two companies, you can spread your basket across hundreds or even thousands of stocks. It's one of the easiest ways to invest with minimal effort and minimal cost. With a single ETF, you can get exposure to the entire market, different industries, or even specific themes like technology or energy. And one of the biggest advantages of ETFs is that they align with a passive investing philosophy. And studies show that over 90% of active traders and professional fund managers underperform the market over time. 90%. That means statistically, most stock pickers don't win in the long run. So why try to beat the market when you can just own it? So ETFs remove the stress of market timing, stock picking, and constant research. And it's an ideal strategy for long-term investors. But then again, do you really want average returns? If you're chasing massive gains, ETFs might not be the most exciting, vehicle for you. However, their steady compounding growth over time can be a powerful wealth building tool. At the end of the day, choosing between stocks and ETFs comes down to your investment style and risk tolerance. Do you want control and the potential for higher risks, higher rewards, or do you prefer a simpler, diversified approach with lower risk? There's no right or wrong answer. It really just comes down to what is the right fit for you. So next, Akshay will be taking you through the risk factors involved with both.
Perfect, Faisal. Thanks a lot for introducing that and making a case for both of them. Now, risk and return, right? These are the two factors that define every investment decision that you make, right? I think a lot of people will always talk about the result that they get, but usually with that comes a decent amount of risk. So let's start with stocks. Individual stocks can offer extraordinary returns, as you just mentioned, right? But they come with equally extraordinary risks with that, right? Think about your companies, your Tesla, Apple, Nvidia. Early investors saw exponential gains, right? They, as you mentioned, life-changing gains for a lot of people. But for every Tesla there are countless companies that have failed or stagnated. If you pick the wrong stock, you could lose a significant portion of, some of the investment or even all of the investment. Now, to contrast that with ETFs by their nature smooth out risk. Instead of betting on a single company, you hold a basket of stocks. If one underperforms, others in the ETF help balance that loss. So the trade-off, whilst ETFs lower risk of, the catastrophic loss, they also limit the potential for massive individual gains. You won't get the same kind of life-changing return you might from being that early Tesla investor, but you also won't wake up, one morning to find your portfolio has cratered because of one single bet. So I think the real question is, it's not about choosing one or the other, it's about how much risk are you willing to take as an investor and what level of uncertainty can you stomach? So it's something to think about, but that's the side of the risk. But when we look at the actual performance of the two, right? Let's put theory into practice. How do individual stocks actually perform against the broader market? And I wanted to, when we were doing the research for this webinar, it's so easy. I think a lot of times you think about, the best performing stocks most recently, right? It's something called recency bias. You tend to side towards what you've seen. So I'm guilty of it myself. I said Nvidia, I said Tesla, I said Amazon, these are all these incredible companies that have done so well over the past few years. But I wanted to change that up a little bit, right? So let's use the most well-known benchmark on this chart is the S&P 500, right? So this performance showdown is comparing the S&P 500 to two stocks. So the S&P 500, for those who don't know, it's a diversified basket of the 500 largest companies in the United States. And the two stocks that I've used is, one of them is Tesla, right? High risk, high reward innovator that's, shaken up the automotive industry and energy sectors. And the other is General Electric. So GE. It used to be a titan of industry and a household name for over a century, was always included in these, top performing stock lists historically, but over the years started to tether out. And the reason why I wanted to include General Electric in this performance showdown is because 20, 30, 40 years ago, everybody used to talk about GE, General Electric, the same way that they would talk about, your Amazons and your Teslas. It was a household staple name when it came to stock market investing. But if we actually look at the numbers, right, the S&P 500 over the years, and this is looking at a 10-year period, right? The S&P 500 has delivered steady compound growth, makes it very reliable, low maintenance. If you'd simply invested in the S&P 500 and left it alone, you would have seen very strong, consistent returns. Now, General Electric, on the other hand, despite its past dominance, has failed to keep up with the broader market, right? It was once considered a rock solid blue chip stock. GE's decline in the recent decades, it kind of serves as a cautionary tale. Yeah, even the biggest and most respected companies can underperform. And if you'd invested heavily in GE rather than a broad market ETF, your portfolio would have suffered quite significantly. Now, the last one, and you can see this chart, I think it doesn't really do a great job of showing the difference between General Electric and the S&P 500, but the difference is, the S&P 500 is double compared to GE over that time. But this nice blue line is Tesla. And Tesla, on the flip side, has dramatically outperformed the S&P 500. Early investors, as you can see, saw astronomical gains, and this really turned small investments into life-changing wealth. But right? The same as GE, right? Tesla's journey was not without a lot of volatility, multiple crashes, recoveries along the way. So few investors had the discipline to hold through that kind of turbulence, but the ones who did would have reaped an exponential reward. So what is I guess, the lesson here, right? So stock picking, as we can see, is very hard. You might dream of picking the next Tesla, but you might, land up with the next GE. The S&P 500, in contrast, provides more of a safe long-term growth path without that stress of individual stock market risk. And this is why a lot of investors tend to choose ETFs. It offers this exposure into companies like Tesla, but also protect you from picking maybe the next GE. But also remember, the exponential return of Tesla eclipses the S&P 500. There's a huge difference. So once again, risk and reward for all of these things. Now, what I wanted to talk about a bit now was more about, as opposed to stocks or ETFs, a little bit more about the investment philosophy that associates both of these. Now, active and passive investing. And this is a debate. I think we've had this debate in Sarwa before. We've had this conversation with clients for a long period of time. And it's the old question of active or passive, right? Which strategy actually works better? And look, the truth is, it's not a simple black and white answer. The stat over here, over 90% of the professional fund managers underperform their benchmark. If the pros can't beat the market, can you as an investor? Now, active investing, it kind of involves selecting individual stocks or actively managed funds with the goal of outperforming the market. Passive investing, this involves tracking an index like the S&P 500 or through ETFs or index funds, or even buying, individual stocks and holding them over longer periods of time. Now, the case for passive investing is, as I said, right, it's been very successful for a lot of people. It tends to have low fees, doesn't require active management. It's emotionally a lot easier. You're not constantly making buy or sell decisions. But a very important distinction, passive investing doesn't just mean ETFs, right? You can have a passive approach with individual stocks, buying and holding a diversified set of high quality companies for the long term without frequent trading can be a passive strategy. So you can have a passive strategy with stocks. Now, with active investing, right, despite the data favoring passive investing, active investing is still very widely used, and for good reason. A lot of investors do actually beat the market. Professional investors do it as well, right? Warren Buffett, Peter Lynch, Cathie Wood, these are all, historical investors and sort of epic investors who have outperformed over time. Not all of them at all times, but over time, right? It's difficult to replicate their success. But what I mean by that is, look, active ETFs also exist, right? These ETFs are managed by professionals who select and adjust holdings very dramatically, right? They aim to outperform while still providing ETF structure benefits. So you can just buy into an ETF, but the strategy of the ETF is very specific to, basically a certain theme or a certain conviction that an asset manager might have. So this is, as I said, the sort of debate between passive and active, but with both stocks and ETFs, you can use a bit of both. Now, I guess what I wanted to kind of close off the presentation part of this is, which one is right for you? A lot of people in the audience are probably thinking, look, I, only will stick to ETFs or I will only stick to stocks, and I love trading stocks and I've gotten a really, really good, return. But I think we're of the firm belief that, what if you can just balance the best of both worlds? For many investors, the smartest approach is actually a hybrid strategy. You don't have to go one way or the other. It's important to use ETFs as a stable foundation. A lot of people do that while maybe selectively picking stocks for potential outperformance. And there's different ways of how that can look. We speak to a lot of clients who do want to try to balance this approach, and we tend to recommend something called the core and satellite approach, right? A core approach, which or a core portfolio could represent maybe 70 to 80% of your investments. This could be in a more passive or ETF approach, low cost index funds. This ensures steady long-term growth. And then the more satellite approach, the satellite portfolio, which maybe represents 20 to 30%, this could be in individual stocks. This is where you can take calculated risks. This can be when if you have certain convictions about specific companies or sectors or geographies, you can take, more of an active approach in that. I think it's a fantastic way to learn about companies if you are interested in learning about the market, and also a really good way if you do have convictions about these things and if you're passionate about certain companies. What better way to get exposure to them than to actually invest your capital with them? Now, why does this core and satellite approach work? And I'd say the main reason why it does, it is, I would say, one of the best risk management tools out there, right? It keeps your risk in check. Even if your stock picks fail, your ETFs are there to provide stability. It lets you participate in those high growth opportunities. So if you do find, the next Tesla, I'll even say, if you find the next big cryptocurrency, which is obviously a little bit off topic, but you still have that exposure where you are put in a position where you're getting that high growth opportunity, but not sacrificing the opposite or the downside of that potential. And another really key point is it prevents emotional trading, right? A strong ETF foundation or passive foundation can really help you not panic during market downturns. And I would say we always like to use some analogies at Sarwa, but I would say think about it like building a house, right? A solid house foundation. ETFs are the solid foundation that kind of holds everything together. And individual stocks can be customizations. This adds uniqueness and potential flair. This strategy actually allows you to capture market growth, but still taking a shot at some of these outsized returns. And as I said, right, I think ETFs are not just for passive investing. I think when people think of ETFs, they assume a broad passive index fund like the S&P 500, but in reality, ETFs have evolved into a very powerful investment tool that can almost match any strategy. And when we speak to clients, we speak to colleagues, the amount of ETFs that are coming out there, right? There's broad market ETFs that track indexes. There's thematic ETFs that track trends like AI and electric vehicles or fintech companies. There's even sector-specific ETFs that track healthcare. There's crypto ETFs that give you exposure to Bitcoin and Ethereum. There's dividend ETFs that focus purely on high dividend payouts. ESG and ethical, ETFs or Sharia compliant ETFs. So there is a whole menu and an option, a whole, list of ETFs that provide that diversification whilst also giving you a decent return if that's what you're after. And as I said, I think that hybrid approach is usually a good way to take it. One of the nice things is, even on our platform on Sarwa Trade, you can, navigate, thousands of these ETFs. That's why if you want to look at different risk levels or investment goals and interests, whether you're looking at more of a stable or long-term portfolio, or if you want these niche markets, there's kind of an ETF just for about everything. So I think combining ETFs with a a few well-researched stock picks, you get the best of both worlds, right? Diversification, stability, and potential outperformance. So look, the bottom line, and before we kind of move on to the discussion part and the Q&A, what I will leave you with is, look, if you have the time, the expertise, the conviction to analyze individual companies and handle volatility, stocks might be a very good choice for you. If you want low cost, stress-free, long-term growth, ETFs are likely the better fit. Or, like a lot of people, if you're somewhere in between, you don't have to choose, right? A mix of both ETFs and carefully selected stocks can be a great balance, right? Ultimately, investing isn't about chasing the highest return. It's about building a strategy that aligns with your goals and your risk tolerance. Perfect. So Faisal,
Thank you, Akshay.
yeah, of course. No worries at all. So yeah, maybe before we head into the Q&A part, I know that we wanted to kind of dive a little bit deeper into this topic. So maybe we
Yeah.
can then jump into the Q&A.
Yeah, thank you. I see a few questions here already. Please keep sending your questions in. We'll get to them one by one. Should we just open it up and take the first one?
Let's do it. Yeah.
All right. So we have here by Anonymous asked how to compare performance across ETFs. Is expense ratio the only relevant metric? So expense ratio, I would say, is one of the most important ones, but there are other factors you should consider, like the tracking error, right? So how closely is the ETF in performance, in relation to that benchmark? And then also liquidity and trading volume, right? Higher trading volume means better liquidity. Also the tracking error. So there are other factors you can consider. So even though two ETFs might be tracking the same index, they could vary significantly across those factors: expense ratios, tracking errors, liquidity and volume, and also AUM. The higher the AUM, the more likely the fund will be stable and less likely to be illiquid.
Yeah, I'll also say like usually when we have, obviously the Sarwa investment team and investment solutions are quite broad, right? We have, a combination of multiple different asset classes and the ETF side of things is something that we obviously focus on and we always have. And, there's actually loads of different criteria that you can use to analyze an ETF. But as Faisal said, I think usually the four sort of main ones are the cost of them, the liquidity, the capitalization, and the tracking error. These are I'd say the four main questions that you should probably ask if you are looking to analyze an ETF. But, if you want to get super granular, there's a lot of other, things that you can look at. So we have a question here from Mohammed. Mohammed's asking, can ETF returns outperform individual stock returns over a minimum 15-year investment horizon? And which asset is better suited for long-term compounding? Okay, so can ETF returns outperform individual stock returns? The answer is yes, they can. The General Electric slide, as I can maybe go back to that slide again, the performance one. Look, when you look at it like this, right, the S&P 500, which can be represented as an index or an ETF, has beaten a lot of individual stocks over a 15-year period. That is, that's been very common. However, there are also individual stocks, like in this example, like Tesla, that have outperformed, the benchmark or the index quite significantly over a 15-year period. So the answer is yes, they can, and historically they tend to, but there's also a lot of, I guess, outperformance that's been visible with individual stocks. And look, which asset is better suited for long-term compounding? Look, at the end of the day, when you're looking at compounding and when you're looking at stocks and ETFs, with ETFs, you can have ETFs that track not just stocks, right? But you can have ETFs that track different asset classes. You can have ETFs that track commodities. You can have ETFs that track cryptocurrencies, ETFs that track, fixed income, even real estate. So there's so many different asset classes that ETFs can track. And, equity ETFs, stock market ETFs, have compounded, really, really well over longer periods of time, right? When you look at, more stable asset classes like fixed income ETFs, maybe not the same, but I would say historically, a stock market ETF has done very well when it comes to compounding. But the same thing with individual stocks, right? When you've picked the top performers, that compounding effect and that growth over time is really what makes a difference. And I'd say with both of them, right, regardless of whether you're going for a stock or an ETF, having time in the market is usually one of the most beneficial things that you can do. It reduces risk, it reduces volatility, and really enhances that growth.
Thanks, Akshay. Um, we have a question from Jagdish. Jagdish asks whether the money is invested will be safe, irrespective of geopolitical tension. Is there any guarantee if the platform or fund manager has issues? That's an excellent question. And it's important to note that ETFs and the fund managers are separate entities, right? So if the fund manager were to tank, the ETF is held separately off their balance sheet, so it shouldn't impact the assets themselves. So, of course, the more reputable and larger the fund manager is, the better off, and the more likely they will to tank. So, but the bottom line is they're separate legal entities from one another, so there shouldn't be any exposure or any risk from that angle if the fund manager were to tank or collapse.
Perfect, Faisal. Thank you for that. Okay, so we've got a question here from Daraj. It's actually a really good question. ETF versus index fund. How to decide which is better? So, Daraj, just to kind of give you an understanding, right? Both ETFs, so in exchange traded funds and index funds, are passive investments in most cases that track specific indexes, but they have some differences in how they operate, right? Index funds by nature are mutual funds. So index funds, they're bought and sold only at the end of trading day, as opposed to ETFs, which trade like stocks and they trade on exchanges, which means that you can buy and sell them actually throughout the trading day as at market prices the exact same way that you would a stock. Usually, and this is not in all cases, when it comes to costs, ETFs typically have a lower expense ratio and no minimum investment amount. But sometimes, you'll pay, brokerage fees when you buy or sell them. Index funds, on the other hand, look, they have usually a higher minimum investment amount, but they don't have trading commissions as per se, but their expense ratios tend to be more expensive. And look, I think in terms of like investment strategy and accessibility, ETFs tend to be a lot more accessible because you can also have limit orders, stop losses, different mechanisms for trading ETFs or investing in ETFs. Index funds tend to be a little bit more of a set it and forget it approach. But I think overall, the two main things I would say is the trading element of it, where ETFs trade like stocks and you can trade them all day, and then the costs also tends to be quite different between the two.
Thanks for that, Akshay. Let's see what other questions we have. We have a general question here. I'll just get it out of the way. It's from Anonymous. And Anonymous is asking, I'm Dubai-based. In the future, when I leave the country for good, what happens to my investment? Can they continue to grow, or do I need to close the account? And is there an exit tax applied in the region? Short answer is wherever you go, your Sarwa account will follow you, with some exceptions to the rule. If you go to a sanctioned country, then you might not be able to use it. If you become a US taxpayer, then you might not be able to. Other than that, you will still be able to fund and withdraw funds from your settle account, no matter where you are. So you won't have to close your account, and there is no exit tax in the region, as far as we know, and to this day. So there's not going to be any implications on that front as well.
Amazing. Thank you for that, Faisal. So we've got actually another really good question over here, Anonymous. So what are few of the best recommended ETFs that can be invested on the Sarwa platform? Now, there's actually two solutions that you can use on the Sarwa platform to invest in ETFs. Now, the first one is Sarwa Invest. And Sarwa Invest is our globally diversified ETF investment managed portfolio. And the nice thing about it, obviously, is that our team and our investment committee has actually gone into the market, analyzed, the overall market and identified these ETFs as the most cost effective and the ones that have the least tracking error, that have high liquidity, high capitalization, and really good performance. So we, on the Sarwa Invest side of things, that has been, really, really popular, and well researched. And we've had an investment committee and a team that takes care of all of that for you. Now, let's say that if you want to invest in your own ETFs, you can actually do that on Sarwa Trade. And on Sarwa Trade, we actually have lists on there, like most popular, individual stocks, but there's also some lists for ETFs, ETF and exchange traded commodities also. So we won't necessarily, provide you with a recommended, because each individual, investor is going to have their own goals and objectives and time horizons, and each ETF might suit them different. But one thing that you can do is look at the analysis that we, talked about before. Look at the cost for the ETFs. Look at the tracking error. Look at the performance of it over the past few years. And one thing that's also pretty interesting and cool on the Sarwa Trade app is you can look into individual securities, whether that's stocks or ETFs, and they have something called analyst recommendation. So a buy, a hold, or a sell kind of recommendation will be there. Not as I wouldn't actually, it's not necessarily a recommendation, it's what analysts are doing in the marketplace. So that's also a good tool to look at.
Thank you, Akshay. There's a great question here by Nimanja. They asked, do the ETFs have better liquidity than index bonds? Typically and usually, yes. So stock ETFs tend to be more liquid than bond ETFs, but that's not always the case. There are certain bond ETFs that are as liquid as stock ETFs, but generally, yes, stock ETFs are more liquid.
Yeah, and also just say, just by nature, the bonds traditionally are traded something OTC, which is called basically over the counter. So they're not on exchanges. Usually, in order for a company to be on an exchange, the liquidity and the trading volume needs to be very, very high to be listed on that exchange. So as a result of that, the liquidity tends to be a decent amount better. But at the end of the day, if it's an ETF, it's still going to have a decent level of liquidity. But always look at these things, right? ETFs that are trading below $1 billion in market capitalization. That's something that is actually lower market capitalization. So you always want to be careful with what you're looking at.
A follow-up to this is another question from anonymous Akshay, and it asks, which one is better? ETFs that track bonds or ETFs that track the S&P 500? Which one is likely to give me more returns in the long term? So,
Um,
specifically the S&P 500 versus it's kind of hard to answer that question without a specific bond ETF or a specific bond segment to compare it against. Usually the S&P 500 in particular will outperform bonds, right? Stocks historically have outperformed bonds. So the short answer, I would say a stock ETF or a stock ETF that tracks the S&P 500 should outperform bonds.
Perfect, Faisal. Thank you for that. Okay, let's see. So we've got a question here from Diraj who's asking, for a new 18-year-old investor, what can a typical ETF basket look like? So really good question, and it's amazing that Diraj, you're looking to invest at age 18. We actually did a summit, a Sarwa, our inaugural Sarwa summit over the weekend, as well as last week. And one of the things we talked about is the importance of starting investing early. So congratulations on that. Now, what I will say for a typical ETF basket, right? One of the best ways to do it is making sure that you're well diversified from an asset class perspective. So making sure that you're covering different asset classes like stocks and bonds and real estate and commodities. Make sure that you are covering different geographies, right? So the United States, the rest of North America, Europe, developed markets, emerging markets, and then also make sure that you're covering every single major sector that you can think of. So financial services companies and tech companies, and information, technology, as well as consumer staples, healthcare, you name it. All of these companies should be, in your portfolio or your basket of ETFs. Now, one of the best ways to do that is by buying all world ETFs, right? Ones that cover all the different things that I just outlined. Another option is to buy, individual ETFs that actually cover these specific markets or geographies or sectors. So I would say the most important thing to do is, as a starter, is to make sure that you're well diversified. And a really good way to do that is on the Sarwa Invest side of things, where you actually have the ability to just invest money and it's invested into a basket of different ETFs. What I would recommend doing is trying that out initially, see how that goes. And if you obviously, are happy with that, you can continue to do so. Whilst you get more experience, you can maybe start looking on the trade side of things, identifying some ETFs that you might be interested in or some individual stocks. And that's always a really good place to start.
Thanks, Akshay. We have a great question here from Miko. And his question is, what are your thoughts on selling your positions on an ETF or stock once you make a profit, even a small amount, and rebuying the same ETF on the current rate just to add to the compounding? I understand that you still profit, it's still unrealized until you sell. Just hold off on a loss. That's a great question. So here, this strategy would essentially, the way I interpret it, as you're trying to time the market and capitalize on those short-term profits. But that often is a strategy that does not work. So time in the market often beats timing the market. Plus, you might incur some transactional fees. And if you do, or if you are liable to pay capital gains tax, and you are subject to those taxes. So I would say holding off and letting your investment compound and accumulate and reinvest is a far better strategy than exiting and re-exiting the market, because you might miss out on, even if it's a few days of the best trading days of the year. If you just miss out on those days, then you could have missed out on the best returns for that year. So staying invested will often beat timing the market.
Yeah, Faisal, 100%. Now, we've got a question over here from Mohammed, who's saying, how should you analyze an ETF before taking a trade? What factors should you consider? And should you evaluate all stocks in its basket? So look, when you're looking at analyzing ETF, as Faisal mentioned previously, looking at the cost, the liquidity, the tracking error, the capitalization, a few other things, performance, these are things that you should look at, right? These are different factors. And yes, I think that if you do want to get a bit more granular, a really good approach to take is when you go onto an ETF website, or if you look at the fact sheet, it will usually share the holdings that are in the ETF, right? Usually on the website, because the fact sheets will kind of share the top ones. And you can actually scroll through the hundreds and thousands of different individual companies that are in those ETFs. Now, I think that's exceptionally important if you might have any religious or ethical obligations, and if you want to basically make sure that there's certain companies that are basically in the portfolio, if you don't want them to be and whatnot. So one of the best ways to do it is actually looking at the underlying holdings, and also making sure that those holdings represent what you're interested in investing in over the long term.
Great. Thank you for that, Akshay. All right. Do we have
Okay.
any more questions?
Yeah, I think we've got one from Lena, who's asked, which ETF would you recommend investing in? Is Vanguard, VOO, VEA, VT, and iShares Russell good to invest in? Now, Lena, with this, it's going to be very difficult to say what we would recommend investing without understanding more about your circumstances, right? Lena, your risk tolerance might be very different to mine or Faisal's or anybody else in the audience. I think it's really important for to basically make these recommendations. You would have to understand more think about your time horizon, think about your objectives, your goals, and if these things align with these ETFs that you're looking at, then by all means you can look into investing in them. But make sure that you do your research. At the end of the day, it's really important, right? Right. Look at that criteria that we've identified. Look into the ETFs a little bit more to make sure that they make sense. But as I said, it's gonna really depend on your circumstances, how long you're looking to hold the ETFs for, how long, you're basically, looking to invest for. There's a few other things. So I would say best thing to do is kind of customize it to your own circumstances.
Thanks for that, Akshay. That's a great answer. And it actually answers another question we have, which is what are your top three global ETFs picked for this month? So yeah, I would say the answer, as Akshay said, is subjective based on your objectives, your risk tolerance, your strategy. So it really is on a case-by-case basis.
Yeah, it's true. And I think also with that, it's quite interesting because, with sort of global ETFs and when a lot of people ask for recommendations for ETFs, and it's difficult to say, what specifically to invest in, because as we just mentioned, it's going to depend on you and yourself. But I think
Yeah,
also another thing we didn't really I guess, specify this too much because it kind of goes hand in hand with the criteria that we'd outlined. But also look at the asset manager who's producing the ETF, right? In a lot of
right.
cases, the big asset managers like BlackRock and Vanguard, these are really big asset managers that produce good investment solutions. It's why we have them in sort of our Sarwa Invest portfolios for a reason, right? They're the two biggest asset managers in the world, and usually with that comes some benefits. So also look at the asset manager and make sure that the asset manager themselves aligns with the sort of outcome that you want. Amazing. I was also, whilst we were having this discussion and getting the audience questions as well, I was gonna, ask, what do you think is more dangerous when it comes to, being more diversified, like over diversified or under diversified?
It's a good question. I would say it also depends on a few factors. But so if you're under diversified, it means your risk relatively is higher, right? Because if you're focused on a couple of different stocks or maybe even a certain industry, then if those stocks tank or that industry tanks, then you'll feel the impact much more significantly had you been over diversified. So if you're over diversified, then essentially your returns might not be great. But if markets are unstable and they're out of whack, then your risk is spread across much, much more different stocks or different sectors. So really, again, goes back to your risk tolerance, right? If you're under diversified, you could have a potential for higher risk, higher returns. But in the case that those sectors or those stocks do well, then that would outperform a portfolio that's over diversified. So it really goes back to that risk tolerance aspect.
Yeah, definitely. That's a good answer. We actually have another question here from Anonymous, who's asking about what about US Treasury bills, ETFs, in comparison to stock market ETFs? Now, look, at the end of the day, look, we don't even need to have the ETF part of that. We're comparing US Treasury bills compared to equities. And these are very different asset classes, right? US Treasury bills, this is investing in very short-term US government debt, Treasury bills with maturities of less than a year. They're backed by the US government and considered, almost a virtually risk-free asset. Stock market ETFs, on the other hand, this is investing in equities, right? This can be broad market, this can be specific or thematic ETFs, whatever it might be, but usually equities by nature tend to be more volatile, higher growth as well. So I'd say the US Treasury side of things, this is ideal for a conservative investor, maybe short-term cash management, or even parking some, basically a place to park some cash if you're saving for a specific thing in mind in the near future. Stock market ETFs, this is ideal for a long-term investor to grow wealth through capital appreciation and dividends. And that capital appreciation plus those dividends and that compounding effect over time is the sort of perfect magical solution and formula to grow wealth. So two very different asset classes.
Thanks, Akshay. While we wait for more questions to come in, maybe I can ask you essentially what you think about sector-specific ETFs. So they seem to be somewhere between stock picking and just going and covering the full market. So what's your take on industry or sector-specific ETFs?
So it's interesting because I think with the sector specific ETFs and these more thematic ETFs, they're a really it's almost like a nice hybrid between investing in individual stocks yourself
Yeah,
or completely just investing in an index fund. I think it's a
yeah,
nice in between where if you are passionate, let's say if I'm Akshay and I'm super passionate about the technologies sector, but I don't want to go out and buy, each individual big technology company out there and continuously monitor them and manage them. That's why I think a thematic ETF is actually a really interesting tool because it provides you the opportunity to get that exposure and a little bit of an overexposure if you do have some convictions towards it. So I actually think it's almost like a nice middle ground between the two, right?
Yeah.
But at the same time, right, I think this is where the core and satellite approach kind of comes in. You also want to make sure that are technology companies or is this theme that you're looking into, is it something that is aligned with your risk tolerance and is it aligned with your objectives and your time horizon? So always take that into consideration and don't, purely base an investment decision on if it's a hot topic at the moment, or if your friend is doing it or something like that, right? Have a more, I guess, have a methodology and a reason as to why you're going to do it, and then do it.
Thanks. Thanks. That's a great answer. And I think it goes back to the initial question you asked me, being over diversified versus under diversified, right? So if you invest in an industry specific ETF, you risk yourself being over diversified, but at the same time, it could reap better rewards.
Oh yeah, definitely. So I'm going to ask you one last question. So do you think investing success is more about strategy or investor behavior?
Oh, that's a big one. Um, I think strategies are one in a million, right? So you can have a number of different strategies. But if you have a good and sound strategy, one that works for you and works for your objectives and is in line with your risk tolerance, then it will ultimately boil down to your behavior, right? So you can have the best strategy, but behave in the worst way, and that will just derail your investment, sideways. Whereas if you have a good strategy, a sound strategy, and you practice, you have good behaviors that you stay invested and you kind of tune out the noise and uh, you consistently add to your investment regardless of market condition, then with time you will often beat or you'll often see good gains. So I think having good behaviors will outshine your strategy. So I think ultimately it'll come down to good practices and good behaviors versus having the most complex and savvy strategies. But curious to see what you think on the two.
Yeah, look, I'll be honest, I couldn't agree more. I think it's, a lot of people that we speak to and a lot of investors, they have all of the right, methodologies and systems in place and everything. But a lot, more often than not, people let their emotions get the better of them. And that behavioral piece is so key in investing. I think a lot of times when we
Yeah.
have conversations, it's about, look, we'll always say, hey, look, if we look at this is what the data says, if you invest in this super high risk, growth portfolio or whatever it might be over X amount of time, this is the return you'll see and you'll be in a really good position. The other piece of that is during that time that you're investing, the market is going to go up and down and up and down and up and down. And can you
Yeah.
handle that volatility? And I think a lot of people think that they can, but then their behavior takes, and I guess their emotions take the better of them, and they tend to, maybe sell at the wrong time or invest, or not invest when they should be investing. So I'd say the behavior part is super important.
Absolutely. Absolutely.
Perfect. So I think that Faisal, we have like one last question I can see. Da, 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 da. Uh, let's take a look. So if somebody was asking, I'm trying to decide between eToro and Sarwa, and I'm looking at a 10-year or more investment timeline, and I'm based in Dubai. So, I mean, obviously you're going to be a little bit biased over here, but at the end of the day, Sarwa is a UAE based investment platform, and I think that if you are based here in the UAE, some of the benefits that we obviously have being based over here is local funding. So you're basically able to fund your account for free locally. Link your bank account. We partnered with all of the major banks here in the UAE, so it's a really really good solution for that. When it comes to, access to different and various investment solutions, right? We have all the major asset classes on our platform. So investments in that is, span from equities and fixed income, commodities, real estate investment trusts, crypto. You can do it yourself. We can do it for you. We've got saving solutions on there. We've got a crypto, trading account also. And so really a one-stop shop when it comes to everything personal finance. We're also regulated here and operate here in the UAE, which is really important for you being UAE based. And also an amazing customer support and advisory team that's also, helps you with everything. So yeah, Faisal, I don't know if you want to add anything else.
Yeah, if I can add to the cost aspect of it, you mentioned local transfer. So you do save on local transfers when transferring to Sarwa versus eToro, which is not present in the UAE, as far as I know. But also, as far as I know, eToro charges additional fees when it comes to trading, like inactivity fees, custody fees, and whatnot. Whereas with Sarwa Trade, you only pay a trading fee, and that's it. There aren't any maintenance fees, custody fees, or inactivity fees. So from a cost perspective, it could be more favorable option, but you would have to do your due diligence on that.
Yeah, and also we'll say like from Faisal, you just mentioned from a cost perspective, and even from a general investment perspective, I think something we pride ourselves on being is very transparent. We outline very clearly, exactly what our fees are,
Yeah,
and there's no hidden commissions or withdrawal fees or inactivity fees or all of these other things. I think with a lot of platforms, unfortunately, and then this is a lot to do with the regulatory environment that they might be in, where they have, they basically hide fees and they don't show the full picture, and they've got different models where some people are priced with a certain tier and whatnot, and so I think we like to be as transparent and fair as possible. So that's kind of the approach that we've taken. Amazing. Perfect. So Faisal, I think that's everything that we've covered for the presentation. So I wanted to say everybody on the call, thank you so much for joining us. Really appreciate you taking the time out of your day. Really hope that you learned something valuable, whether it's deciding about investing in stocks or ETFs, or whether if you want to do both of them, that's obviously an option as well. I don't know how you can do the poll, but would
I
love to hear.
tried.
Yeah.
I tried to do it, but I think it's something we had to set up before. But yeah, I guess people can just type it in to the chat or to the question
Oh,
function.
oh no, I feel bad. I just realized that some people have written questions, so we
Oh,
have some time to answer them. Apologies. Um,
oh yeah, okay.
that's my bad. Okay. We've got a question over here, so I think we've got two more questions. How can we be sure that our investments are safe with Sarwa? So that's a really good question. So look, we obviously take safety and security, really we try to prioritize it when we look at the platform. We've got a lot of guardrails in place to make sure that your assets are kept safe and secure. So the first thing is regulation, right? We make sure that we work with a really legitimate financial services regulator, the FSRA, which is in ADGM and Abu Dhabi Global Markets. And they basically ensure that we work with international brokers and custodians, where your assets are actually kept safe and secure. So if SAR was to not exist for whatever reason, your assets would still be safe and secure because they are held with these brokers and custodians. And there's a lot of guardrails that are in place to make sure that everything is kept safe and secure. So that's from the sort of safety and security piece.
I'm just answering a couple of the questions via chat.
Perfect. Yeah, so I think also have another question is, can we buy Chimera ETFs using Sarwa? So as long as it is listed on a US exchange at this point in time, you do have the ability to buy that ETF. So you can just search the ticker or the ISA number on the Sarwa trade feature, and you'll be able to identify if it is there. Amazing, Faisal. I don't think I'm missing anything else, right? Further questions?
Sorry, I was typing an answer. Did we get to this question from Anonymous?
No, I don't think so. Maybe I'll let you take that one.
Okay, so the question from Anonymous is considering long-term investments more than 10 years, with big amounts and for people outside the UAE, should I go for Sarwa or other trading platforms? We had answered a similar question to this earlier. So whether you're in Sarwa or you're in the UAE or outside of the UAE, you'll still be able to access the platform and utilize it and use, whether it's a UAE bank account or a bank account in your home country, you can still make deposits and withdrawals to your Sarwa account from wherever you are, with certain exceptions. So if it is a right fit for you, for your objectives, for your strategy, then by all means, you don't have to be in the UAE to be able to use Sarwa. We are a global platform. We service clients that never lived in the UAE, spread across the world. So if you'd like to learn more about Sarwa, if you're new to the platform, feel free to reach out to our customer support or visit our website, and we'll be happy to support you further.
Yeah, definitely. I was gonna obviously emphasize that if you do have any questions, or if you want to speak to, one of the members of our team, our advisory team, to kind of strategize something more bespoke for yourself, please don't hesitate to reach out to our customer support team, and they can connect you to us, and we can have a more in-depth conversation about that.
Wonderful.
Amazing. Great. I think we have answered everything now. So once again, everybody, thank you so much for joining. We really, really appreciate it. If you do have any other questions, don't hesitate to reach out. More than happy to help. And yeah, thank you, Faisal, as always.
Thank you, Akshay. It was a pleasure. Thank you, everyone. It was wonderful being with you here today.
Thank you, everybody. Have a good evening.